Ever wonder why some investors always win in crypto while others lose everything? The secret isn't luck, it's habits. The best investors follow a disciplined system, while amateurs chase hype and end up wrecked. Today, I'm breaking down the 6 proven habits that separate profitable crypto investors from everyone else. Watch till the end, because habit number 6 is the one that most people ignore. And it's the key to long-term wealth. Let's dive in. Habit number 1. They treat crypto like a business, not a casino. Most new investors treat crypto like a get-rich-quick scheme rather than a business. They throw money at random coins, chase trends, and hope for the best. But hope isn't a strategy. Successful investors approach crypto with the same discipline and structure as a business. A business doesn't operate on gut feelings or emotions. It follows a system. Every decision is backed by planning, data, and risk assessment. Crypto is no different. The investors who make serious money in the long run treat their portfolios like a professional operation, not a lottery ticket. They have a plan. Winning investors never enter a trade blindly. They make sure every trade follows a clear, well-defined strategy. Before they buy a coin, they already know when they'll buy, how much they'll invest, and when they'll exit. A professional business operates on data-driven decisions. A successful investor does the same by using technical analysis, fundamental research, and risk assessment before making a move. In contrast, a gambling mentality looks like this: buying because it's trending on Twitter, FOMOing in because a coin is pumping, selling out of panic because of a temporary dip, and holding a losing trade out of hope, not strategy. The difference? A business has a plan. A gambler relies on luck. They track their portfolio. A successful business tracks income, expenses, and profits. In crypto, the same rule applies. Serious investors constantly monitor and optimize their portfolio to maximize returns. They track performance, analyze which trades are working and which are failing, so they can refine their strategies. They rebalance their holdings. As the market changes, they adjust their portfolio to ensure they are holding strong assets rather than chasing hype. They calculate risk versus reward. If a coin loses momentum or becomes too risky, they exit before taking heavy losses. Most retail investors don't even check their portfolio regularly. They buy coins based on emotion and hope for the best. A professional investor monitors, tracks, and adjusts just like a CEO oversees a company's finances. They manage emotions. Emotions are the #1 killer of crypto profits. Market cycles are designed to trigger emotional reactions. That's how whales manipulate retail traders. Successful investors know this and train themselves to stay disciplined no matter what happens. When the market pumps, they stay calm. They don't chase green candles or FOMO in. Instead, they look for proper retracements and enter at strong support levels. When the market crashes, they don't panic. Instead of panic selling, they analyze whether it's a temporary dip or a serious trend reversal. They separate emotions from decisions. Every trade is based on logic and strategy, not fear or greed. A gambler lets their mood dictate their trades, buying out of excitement, selling out of fear. A professional remains emotionally neutral, treating every move as a business decision. The best investors know that crypto is a long game. The ones who win aren't those who chase the biggest pumps. They're the ones who stick to a well-structured, disciplined system over time. Habit number 2. They master risk management. Crypto is one of the most volatile and unpredictable markets in the world. While this creates opportunities for huge gains, it also means one bad move can wipe out an entire portfolio. Most beginners only focus on profits, but the best investors focus on protecting their capital first. Why? Because in crypto, if you lose too much, you won't even have money left to invest when real opportunities arise. Mastering risk management isn't just about avoiding losses. It's about ensuring consistent growth without gambling everything on one trade. They set stop losses. A stop loss is one of the most powerful tools for risk management. Yet, most retail investors don't use it, and that's why they suffer massive losses. A stop loss is a preset price where an investor automatically sells a coin if it drops too much. It helps them limit their losses before things get worse, avoid emotional decision-making in the heat of the moment, and stay disciplined instead of holding a losing trade out of hope. Professional traders set stop-loss levels before entering a trade. They already know how much they're willing to risk per trade, where their invalidation point is, and how to adjust stop-losses as prices move. In contrast, amateur traders often hold on to bad trades, hoping the price will recover. More often than not, they end up watching their portfolio bleed out. Smart investors don't hope. They cut losses quickly and move on to better opportunities. They never go all in. One of the biggest mistakes in crypto is going all in on a single coin. No matter how confident an investor is, putting all their capital into one trade is pure gambling. Successful investors always spread their risk. They follow strategies like position sizing, portfolio diversification, and gradual entries and exits. Amateurs often bet everything on one coin because they think it will make them rich overnight. But real wealth in crypto comes from consistency, not reckless gambling. The goal isn't just to win one trade, it's to survive and grow over many trades. That's only possible if risk is spread wisely. They only invest what they can afford to lose. Crypto is high risk. Even the best projects can fail. That's why professional investors never put money into crypto that they can't afford to lose. Smart investors treat every trade as a calculated risk. They assume that any coin could potentially go to zero, so they never invest their rent money, emergency savings, or life essentials. They don't take out loans to trade, they don't use money meant for bills or necessities, and they don't over-leverage their positions. Instead, they only allocate a portion of their income toward crypto, one that they can lose without affecting their financial stability. The biggest crypto crashes have wiped out entire fortunes overnight. The investors who survive are those who manage risk like professionals instead of gambling with money they can't afford to lose. Habit number 3, they do their own research. The phrase "do your own research" is more than just a popular saying in crypto. It's a fundamental rule that separates winners from losers. The crypto market is full of hype, misinformation, and projects that promise the moon but deliver nothing. The best investors don't blindly follow influencers, Telegram groups, or viral posts. Instead, they put in the work, study projects deeply, and make informed decisions. Many newcomers lose money because they trust hype instead of facts. They see a coin trending on Twitter and assume it's the next 100x. They buy into a pump without checking the fundamentals, only to see the price crash shortly after. Meanwhile, smart investors verify before they trust. They read white papers. A white paper is the foundation of any crypto project. It's the document that explains the project's vision, technology, tokenomics, and use case. Serious investors never invest in a project without reading its white paper first. When reviewing a white paper, they look for clear purpose, strong technology, competent team, and realistic roadmap. If a project's white paper is vague, filled with buzzwords, or doesn't make sense, that's a red flag. They analyze tokenomics. Tokenomics is one of the most important factors in crypto investing. Even if a project has great technology, bad tokenomics can make it a terrible investment. Serious investors study supply and demand, distribution, and utility. Retail investors often ignore tokenomics, focusing only on price. Pros know that price action without strong fundamentals is just hype. They avoid hype traps. Crypto is full of hype cycles. Coins can pump just because a celebrity tweets about them or because influencers are pushing them. But professional investors don't fall for marketing tricks. They look at real value. Red flags they avoid include coins with no real use case, influencers promoting projects without clear fundamentals, teams with anonymous developers and no transparency, and coins that pump rapidly without any news or development progress. Instead of following the crowd, they verify everything. They check project development progress on GitHub, team activity on social media and forums, and real adoption and partnerships, not just announcements. While retail investors jump from one hyped project to another, smart investors identify solid long-term plays based on deep research. Most people enter crypto with a short-term mindset. They want quick gains, chase pumps, and panic during dips. The best investors, however, understand that crypto is a long-term game. Instead of trying to time the market, they focus on time in the market. They build wealth through patience, discipline, and smart accumulation. One of the biggest reasons retail investors lose money is emotional trading. When prices dip, they panic sell. When prices pump, they FOMO in. This constant cycle of buying high and selling low wipes out portfolios. Successful investors do the opposite. They see dips as opportunities. Instead of fearing corrections, they buy more of strong assets when prices drop. They hold through volatility. They understand that Bitcoin and crypto always go through cycles. Short-term dips don't change long-term fundamentals. They zoom out. Instead of watching one-minute charts, they look at the big picture and focus on long-term trends. The best investors know that Bitcoin has survived multiple bear markets and still reached new all-time highs. Weak hands panic sell, strong hands hold and accumulate. Not all crypto projects are equal. While meme coins and hype-driven projects come and go, real wealth is built by holding strong assets. Bitcoin is the king of crypto, the most secure and decentralized asset. Ethereum is the backbone of DeFi, NFTs, and smart contracts. High-quality altcoins are coins with real-world utility, strong teams, and solid tokenomics. While retail traders chase shiny new coins, successful investors stick to proven assets. They buy gradually through dollar-cost averaging instead of trying to time perfect entries. This allows them to build a strong portfolio over time without being affected by short-term volatility. Short-term traders often take profits too early, missing out on massive long-term gains. The best investors let their profits grow. They use strategies like staking and yield farming. Instead of letting assets sit idle, they earn passive income. They reinvest profits. They don't just cash out. They reinvest profits into more strong assets. They hold for market cycles. They ride the full bull run instead of selling early. Most people look for quick gains. The best investors build lasting wealth by compounding returns over years. Crypto rewards patience, strategy, and discipline. Those who think long-term always win in the end. The crypto market is one of the fastest-moving financial sectors in the world. Unlike traditional stock markets that operate on fixed trading hours, crypto trades 24/7, making it highly volatile and unpredictable. Prices can skyrocket or crash within minutes, and new technologies, regulations, and market narratives can change the landscape overnight. The best investors don't rely on luck. They actively monitor market trends and adjust their strategies accordingly. Those who fail to stay updated risk missing opportunities or, worse, getting caught in sudden downturns. Information is the most valuable asset in crypto. The ability to act quickly based on breaking news can mean the difference between massive gains and devastating losses. Smart investors keep themselves updated with real-time news from multiple sources. They use crypto news websites. Platforms like CoinDesk, Cointelegraph, Decrypt, and The Block provide real-time updates on major industry events, regulatory changes, and technological advancements. These sites are trusted for fact-checked news and deep analysis. Twitter and crypto influencers. Many major developments break first on Twitter, often through industry insiders, analysts, and project founders. Following key figures like CZ, Vitalik Buterin, and on-chain analysts like Will Clemente or Santiment helps them gain insights before the broader market reacts. YouTube and podcasts. Some of the best investors follow daily video updates and in-depth discussions from experienced crypto analysts. Podcasts like Bankless, The Defiant, and Unchained provide expert insights into trends, regulations, and upcoming technologies. Telegram and Discord communities. Many crypto projects and trading groups have private channels where early discussions about market trends happen. Being part of these communities allows them to get insights directly from developers, traders, and other investors. By consuming a mix of mainstream media, expert opinions, and real-time social media updates, they ensure they never miss key developments. While news and rumors influence short-term market sentiment, true long-term investors rely on blockchain data for objective insights. The blockchain is fully transparent, allowing investors to track transactions, whale movements, and liquidity shifts in real time. They monitor whale movements. Large holders can heavily influence the market. If whales start accumulating Bitcoin or altcoins, it often signals confidence in future price increases. On the other hand, large sell-offs can indicate potential crashes. They track exchange inflows and outflows. When large amounts of crypto are moved onto exchanges, it often signals sell pressure as investors prepare to liquidate. When funds flow out of exchanges into private wallets, it indicates accumulation and a long-term bullish trend. They use market sentiment tools. They use the Fear and Greed Index, funding rates, and sentiment indicators to gauge whether the market is overheated or undervalued. When the index reaches extreme greed, it often signals an incoming correction. When the market is in extreme fear, it's often a great buying opportunity. By combining news analysis with on-chain data, they develop a well-rounded perspective and avoid emotional trading decisions. Markets never stay the same. They shift between bull runs, bear markets, and periods of consolidation. Investors who blindly follow outdated strategies often get stuck holding underperforming assets. Smart investors shift to defensive strategies in bear markets like staking, stablecoin farming, and accumulating strong assets at lower prices instead of chasing high-risk trades. In bull markets, they focus on momentum trading, identifying narratives early and riding trends to maximize profits. When regulations change, they restructure portfolios to remain compliant and minimize risks associated with government crackdowns or exchange failures. By staying updated and adapting, they ensure they remain profitable in all market conditions. Wealthy investors never rely on a single source of income. They create multiple streams to ensure financial stability. In the unpredictable world of crypto, having diversified income ensures they always have a backup, even during market downturns. Many people believe they have to choose between day trading and long-term investing, but the best investors do both. Trading helps them capitalize on short-term volatility by using strategies like scalping, swing trading, and breakout trading. This allows them to generate daily or weekly profits even when the overall market is uncertain. Long-term investing helps them build long-term wealth by accumulating Bitcoin, Ethereum, and high-quality altcoins. Instead of reacting emotionally to short-term dips, they buy when the market is undervalued and hold for years. By combining both approaches, they ensure they're making money in any market condition. Rather than letting their assets sit idle, smart investors put them to work by generating passive income. Some of their strategies include staking, locking up tokens to earn rewards while helping secure blockchain networks. Cryptos like Ethereum, Solana, and Cardano offer high staking yields. Yield farming, providing liquidity to DeFi protocols in exchange for interest payments and rewards. They use platforms like Uniswap, Aave, and PancakeSwap to generate passive returns. Lending and borrowing, using platforms like Aave, Compound, and Celsius to lend crypto assets and earn interest rates much higher than traditional banks. Automated trading bots. Some investors use grid bots, arbitrage bots, and AI-powered algorithms to generate passive profits by executing trades 24/7. By integrating passive income streams, they ensure their portfolio grows even when they're not actively trading. Beyond investing and trading, the wealthiest investors create businesses that generate consistent revenue. Some of the most common business models include content creation, running YouTube channels, writing on Medium, launching newsletters, or hosting podcasts about crypto trends and market insights. Many influencers monetize through advertisements, sponsorships, and paid courses. Consulting and coaching, experienced investors offer paid consulting to new traders, businesses, and institutions entering the crypto space. They provide guidance on portfolio strategies, technical analysis, and market insights. Launching crypto projects, some investors take their knowledge further by building DeFi platforms, NFT collections, DAOs, or blockchain-based applications. This allows them to own revenue-generating digital assets. E-commerce and NFTs. Many crypto investors use NFTs and Web3 tools to launch digital brands, sell products, or build online businesses with blockchain-based payment systems. By diversifying their income sources, they ensure they're always making money, even in bear markets. Want to start winning in crypto? Apply these habits today. The difference between success and failure isn't luck, it's discipline. Which habit are you working on right now? Drop a comment below. Subscribe for more insights on mastering the crypto game. Follow us on X, YouTube, Medium, Instagram, and Threads at True Crypto Insights and Crypto Tribex for podcasts.